Good morning, I'm Carol Harmer from Charmer Trading, and again this week I'm going to be talking you through what the Euro did last week and where we expect it to go this week. I'm also going to be doing, not today but midweek, I'm going to be doing a video on the different currencies because as we all know, the Euro really has been sort of entrenched within this range for quite some time. So what I'd like to do first now, we'll start off, as we always do, and we'll look at the weekly chart, just to give us an idea of where we go, or mainly, I'd like to use the weekly and monthly to see where the longer term projections are. So we can see here that the Euro last week did near enough, within a fraction, came to this line here. You can see that line up at those highs are 1376. If you look at the high for the week, it was at 1371. So, you know, we managed to get up towards this line. Obviously, we couldn't stay above it. We are below the 200-week moving average, and we are below the advanced adapted moving average. Now, if you look at the stochastics on the weekly chart, you can see that these are turning negative. Now, because they're turning negative, doesn't mean to say that the euro is going to now fall out of bed. The weekly charts and the monthly charts, the indicators are quite slow moving. So you don't really, all you need with these longer term charts just to keep your eye on them. And you know, you can see quite clearly on that weekly chart that 1360, 1370 area was a sell, which is what I said last week. So if you look at the longer term charts, if you are even trading short term, if you look at these longer term charts, you'll find the levels jump out at you more prevalent, more predictable. So what you can do is you just write them down, so that if you are trading off of a hourly chart in the week and you've got all the noise of each day, every day going through your head, if you keep a note of the important levels that the market as a whole is looking at, you will find your trading will improve so much. If you knew the trillions and trillions of dollars that are traded each day, you can see how the retail market is such a tiny percentage of what is going on worldwide. But, and this is the important but, you can still do it and you can still trade it if you know what the outside world is doing and what the outside world is looking for. The levels. Levels don't change. Central banks use levels. You know, I've done this for 38 years. I've worked in big institutions. I've worked on the life floor. I know what the Bundesbank does, which is now the ECB. You know, we lived with central bank intervention in the 80s all the time, every day. Still levels. They always did levels. So let's go back and take a look at the daily chart. So we are trading around about 12.25 at the moment. Now, if you take a look at these, you can see that these are beginning to enter into oversold territory. At the moment, years ago we used to use 70-30. You know, I use 90-10 these days. So if it's 10% oversold, then, you know, if it's 90% oversold, we've got a problem. If it's 90% overbought, we have a bit of a problem. But if you look and see what the euro's done, you can see that it just did not have the legs to actually make a move. You can see with these candles that we opened virtually where we closed virtually where we opened. So it isn't a fluidy market. This one was a scalper's market, to be fair. And then it makes the dive. And if you can see here, you can see why I say about divergence being very important. Because before we had the big fall 2 weeks ago, you could see on the stochastics that when we were up at these higher levels, this market was diverging. Now, when markets diverge, it should be a stop signal, a reversal signal, a hang on, it's not going to go any higher, and if it does, it's got to take out this to get these back on track. And then we did the same last week. We just went sideways for most of the week, and then we had the Friday close. Now, obviously, with something like the euro, it's going to be reactive at the moment. It really is. I mean, any single piece of news that is coming out is going to have euro traders or currency traders as a whole running for cover. So, although if you look at the long-term trend, there's no question that the long-term trend is down in the euro. But remember, we've come up from 103 and our high was 125.50, and that 125.50 was a 38.2 correction from the move down from 160. So let me just show you that on the monthly chart. Now, as traders, we are naturally feel the need to be in the market all day, every day. You don't have to do that at all. In fact, it probably is detrimental to trading. Now I'm going to show you this monthly chart, and you will see exactly what I mean. Now, anybody can do this, okay? It's where you learn how to do it. And I think with a lot of you retail guys, you're looking at the markets way too short term. You can trade 2, 3, 4 times a week profitably, and that's all you need to do. You don't need to be in it all day, every day, because all you're doing is trading noise, and you don't want to be trading noise. Now take a look at this monthly chart. It really is impressive. So here we have the euro, again monthly, up, down, up, down. Oh, please believe me, it was hectic trading through this lot, but we did it. Now we start to look at this here, where it really did, if you see that triangle-y sort of patternish, then we started to really shank, and as you can see, we went to 120, 103. When on that next month we had a higher month, look, Fibonacci to the base, 38.2. Now, this 38.2 Fibonacci, right, isn't a magical number that just is put out for the universe to trade. It is a mathematically calculated, proven indicator that when it hits a 38.2 and it's still in a downtrend, better believe it, it's still in a downtrend. So how can we take advantage of that? So we're back to this little chart here. What you're doing is you can see that you've got 1187, 1181. So it is low risk to buy down at these lower levels because your stops are going to automatically be down, or my stops are going to be down below here. I look at this daily chart and I say, okay, so far we haven't broken any significant support levels. And this is because the market has gradually gone higher. Now, when you get, especially from something like 103, but when you get higher highs and higher lows, you can normally look at that and just eyeball it and say, I am in an upward channel. The key on this would be a break below here, short term. So if we take out 1150, you've got 1105. You know that because that's where the market went before. And it is only below 1080 that you're going to have a real serious problem. So what I would suggest is that I am going to be buying into weakness in the euro. Yes, it's going to be a contrarian trade, as no one seems to like the euro at the moment. But I'm going to continue to buy into weakness. But I know that my stop is going to be very, very short. And if it's below 1080, I don't want to hold euro dollars. I don't, because I think then you're going to get back into the 2016, 2015. And we're going to be looking at 108, 107, 105, you know, that sort. But for the moment, you are still in an uptrend. Your daily charts are saying that it's oversold. You know that you're in a very, very long-term downtrend. But, you know, just try and stick within the levels. Anybody need any questions answered? You can always email me or emailmarkets.com and they'll email me. And anyway, you know, have a good week and I will catch you Wednesday. I think I'm doing another one. Wednesday. Okay? So just write down those levels, guys. If you write them down, you know that you're going to be okay. Have a great week.